Okay, good people, good people, good people. Yes, traders. Yeah, hope you are doing fine, and yeah, almost everybody's doing well in the market, especially, and also in other aspects of life. So I'm Mr. Assam, and actually today I have got some time, and I want to share a certain piece of information that's going to be very helpful for you traders, whether you are an advanced trader or you are a beginner trader. So this information, if you are going to incorporate in your trading, is going to be very helpful. So the concept today is, our today's concept is just the idea of slippage. I'm sure maybe you have already heard about the concept of slippage. Maybe you don't know exactly what is slippage, and sometimes maybe you have never heard about the concept of slippage. So today you have to stick in this video, and then you are going to understand exactly what is slippage, and also I'm going to talk about what are the causes of slippage, and finally I will indicate, or I will talk about the ways to avoid the slippage in the market, because slippage actually, in most cases we see it in a negative way, but sometimes it's going to be positive. So basically I will describe all of the two sides of slippage, being positive and being negative. So now, what is slippage, by the way? Now, slippage is when the order is filled. Now, it's just maybe in any financial market, whether it's forex, it is stock, or anything else. So now slippage is when the order is filled at a price different from requested price. Yes, I'm sure you're getting this. So actually, when you place order in the market, it means you have a certain price that you are targeted your order to be filled in. So now sometimes you can find that the price that you were requested is not the one your order is going to be filled or is going to be opened. So it is when we say there is a slippage in the market. So when this occurs, it's actually due to different reasons, but when this occurs, can impact your position in a positive way, or it can impact in a negative way. So that is slippage. It may impact in a positive or negative. So now, how can it be positive, how can it be negative, and what are the causes now? Those are the things that I'm going to dig in deeper in my next explanations. So basically, those things happen several times, and for most of traders, they may be not aware of those things that they exist in the market, and maybe they impact their trading. And always those things comes to, they go even beyond, because we know when you are opening positions, you must have specific price for where you are requesting to open your position, and also to close the order. Also, you have a specific price that you will request your order to be filled out or to be closed. So this may also impact the closing price now. So sometimes you may be interested maybe to close your position at a certain price. You will find that now order may be closed at a different price, either higher than expected or lower than expected. That's why we may have a positive or negative slippage. So what is positive and negative slippage may be? Now, slippage can occur when you are either selling or buying an asset. So either you are in a sell or in a buy, always a positive and negative slippage can occur. So positive slippage, maybe you are in a buy. Maybe you are opening a buy position. So positive slippage is when your position open lower than the requested price. So now you have got your own price where you think now is the right time for me to buy or to go in a buy position. Now price is going to open lower than that one. So it is just advantage for you, because it seems like you opened that position very early before price has maybe jumped to that particular position where it is right now. So that is positive slippage. So a slippage may depend, sometimes can be 5 pips, can go even 15 pips or beyond that. So it depends on the conditions of the market. I will explain later what are the causes of slippage, and then we'll understand how it can be that very big slippage or that very low slippage. And now on the other hand, if you are in a buy position now, you want to open a buy position, and then after requesting that, after sending your order, now if that position is going to open at a slightly higher price than the requested one, that will be negative. It is negative to you as a trader. And when I say it is a positive slippage, it is just positive to you as a trader. That's why you'll find that sometimes some people, they have been reporting several times that they were trading, they made their profits, and then the broker says maybe they have violated a certain rule or a certain principle. So basically other things are related with the slippage. So sometimes if you do something that is advantageous to you, but it's disadvantageous to the broker, like things like slippage, always you can find that you enter into trouble maybe during withdrawing your profits. So now if you are in maybe you want to open a buy position and the price open above, it's just a negative slippage. And now this works in the same way when you are in a sell. Now if you are selling, then price now opens, maybe when you have requested a sell position now, then the price open slightly higher than the requested price. That is positive slippage to you. And when it opens lower than the requested price, that is negative slippage. So that's how those two types of slippage may operate, and how they can be advantageous and also they can be disadvantageous on the other way. So now that's how things go. So let us see exactly what are the causes of this, why slippage occurs, and also we'll see how to avoid slippage, and then especially when it occurs a negative slippage now, the one that is against the trader. So you must know how you can avoid that one which is against the trader. So basically slippage is caused by high volatility. When there is a high volatility in the market, it's when slippage slippage is mostly likely to happen. So basically you have to avoid high volatile market if you need to stay away from slippage. Then on the other hand, slippage may be caused by low liquidity. Do you see? So we have those two things there, and those terms actually they are not clear to most of people, the difference between volatility and liquidity. So high volatility is the cause of slippage, and on the other side, low liquidity may be the cause of slippage. So now how those two things are different. Now volatility is all about the rate of exchange in the market now. The rate of exchange in the market, how fast exchange is taking place in the market, that is volatility. And liquidity now, it is another thing. It's all about the depth of buy or sell. The depth of buy or sell. Something which is determined by how many traders are buying and also at what volume now. So when there are many traders who are buying or selling an asset, that asset will become more liquid. And when there are few traders, that asset will become less liquid. So when something is less liquid, becomes more volatile now. So now basically volatility, the one that causes slippage, high slippage, always is mostly likely to occur during major news. I think you know the high impact news. So during high impact news is when volatility is most likely to be high. And also maybe during peaks of the market, you know, peaks of the market. Now when the market is about maybe to close, now in most cases, or immediate after opening, always there is a high volatility. So most people, they may complain that, oh, there is a high spread and everything. So beyond the spread, people, they don't know about slippage. During opening, now it is near to opening or immediate after opening now or closing. Most people, they consider spreads and everything, they don't remember or they don't understand about slippage. So that's how those two things impact slippage. So finally, maybe how to avoid the slippage. That's the last thing. How to avoid the slippage. We have already seen what is slippage. What are now we have seen the types, and then we have seen the causes. And now the final thing, let us see how to avoid the slippage. Now to avoid the slippage, the first thing is just to use limit orders. That's very specific. Use the limit orders. Now when you place instant orders, it's the major cause of slippage. Even though sometimes you can use stop orders, maybe you will find that slippage may occur sometimes. Now price is moving around your order, then it don't open it. Or sometimes you have placed maybe a take profit. Price is moving around your take profit, but it don't close the position. That is slippage. Now similar thing operates on stop losses. You can find that the price is moving around your, maybe not moving around. It is not yet touched your stop loss, but you are already out of the market. So it means there are certain quotes that are beyond the exact market price. So you have to use limit orders, and also do not trade during major news or the high impact news. You have to avoid the trading during those news hours. And also to avoid the slippage, you have to avoid or to stop trading the less volatile, the less liquid now. You have to avoid trading the less liquid assets. Now when it comes to this, it's when I actually tell traders that you have to trade this and avoid this. Trade this, avoid this. For example, on metals, I mostly trade gold. So people, they ask why you are trading gold most of the time, why you prefer gold. So because I see things beyond what you actually know. Maybe you may think, oh, this one because of this, we are trading this, but actually I see things like slippage. I know the idea of liquidity, which asset is more liquid, and why it is more liquid, because most traders, they are participating on it. So basically you must avoid trading the less liquid assets. And the very last thing is the idea of brokers. You have to choose right brokers. And this I have been speaking several times, and people, they think like, oh, all the time I'm preaching about brokers, but I know brokers have got high impact on either you are going to be profitable or not profitable. So there are certain brokers that they are now slippage is mostly likely to occur in their platforms. So when you are using those brokers, always you keep yourself at high risk of facing slippage. So use those recommended brokers. I have been talking about 2 types of brokers for over 4 years. 2 types of brokers. Now two brokers I have been recommending for over 2 years. For over 4 years. So among those brokers that I've been talking several times, I recommend again to stay away from slippage. Use Light Finance Broker. The link is there at the video description. The link is there. Just go there, click the link. First of all, this broker is easy to register. There is easy registration process. Has got a well-organized or well-designed platform. The customer support is very easy. Deposit and withdraw is very easy. And also the verification process is very easy. We have copy trades in this broker. And also we can have the free analysis and everything. So you can just use this broker. Even I have got a channel, and that now in this broker's site, you can see Asam Forex Forecast. I share my own analysis through this broker. So I recommend you to use this broker to avoid things like slippage, as I have said, the tight spreads, or you can open an ECN account, but mostly I recommend you to use a standard account. Use a standard account. So the link is in the video descriptions. So the other broker that I have been recommending, you can use it. You can use it. You can use it. But remember, I have already recommended you to specifically prefer using this broker. So that's how things goes in the market. So I'll be dropping other contents that are very useful like this whenever I have time. So to show your love, to show your support, make sure that you click the like button. Then if you have got any comment, you can write in the comment section. And also, if you think this video is very useful, you can share to your fellow, you can share to your friends. Just make sure that you do any of this, and actually we're going to grow our own awesome Forex community. So thank you for your time and have a good or great day.